Hey everyone, and welcome back to the channel. Today, we're diving into a super important concept in finance that sounds complicated, but is actually pretty intuitive when you break it down. We're talking about the trade-off theory. Ever wondered why some companies take on a ton of debt while others seem to avoid it like the plague? This theory gives us a big piece of the puzzle. So, what exactly is the trade-off theory? In simple terms, it's all about finding the sweet spot for a company's debt. Imagine you're running a business. You need money to grow, right? You can either get it from investors, which is equity, or you can borrow it, which is debt. The trade-off theory focuses on that decision to borrow money. Let's start with the good side of debt. The biggest advantage is something called the tax shield. When your company makes a profit, it has to pay corporate taxes. But here's the cool part. The interest you pay on your loans is tax deductible. This means you can subtract your interest payments from your taxable income, so the more debt you have, the less tax you pay. It's like the government is giving you a little discount for borrowing money. This tax saving directly increases the value of your company. So, from this perspective, it seems like taking on more and more debt is a no-brainer, right? Well, not so fast. This is where the trade-off part comes in. As you pile on more debt, another kind of risk starts to creep in, the risk of financial distress or even bankruptcy. Think about it. If you have huge loan payments due every month, what happens if you have a bad quarter? Or if the economy takes a downturn? Suddenly, making those payments becomes a struggle. This is what we call the costs of financial distress. These aren't just about the worst-case scenario of going bankrupt, which is obviously very expensive with all the legal and administrative fees. It's also about the problems that arise even before that. For example, if your suppliers hear you're in financial trouble, they might start demanding cash up front instead of giving you credit. Talented employees might start looking for jobs at more stable companies. Customers might worry about whether you'll be around to honor warranties or provide support. All these things hurt your business and reduce its value. So, the trade-off theory says that a company's leadership is constantly playing a balancing act. On one side, they want to add more debt to take advantage of that juicy tax shield and lower their tax bill. On the other side, they have to be careful not to take on so much debt that the risk and costs of financial distress become too high. Picture a graph. As a company starts taking on debt, its value goes up because of the tax savings. But as the debt level continues to rise, the probability of bankruptcy also increases. At some point, the rising costs of potential financial distress start to outweigh the tax benefits of adding more debt. That peak point on the graph is the optimal capital structure, the perfect mix of debt and equity that maximizes the company's total value. Different industries will have different sweet spots. A stable utility company with predictable cash flows can handle a lot more debt than a volatile tech startup whose future earnings are uncertain. The startup would have much higher bankruptcy costs because its value is tied to future growth opportunities, which would disappear if it went under. So, the next time you see a company's financial statement and look at its debt levels, you can think about this trade-off. They're not just picking numbers out of thin air. They're trying to find that perfect balance between the tax benefits of debt and the potential costs of financial trouble. It's a fundamental balancing act that helps define a company's financial strategy and ultimately its success. I hope this breakdown made the trade-off theory a little clearer and more practical for you. If you found this helpful, be sure to hit that like button and subscribe for more videos where we break down complex business topics. Thanks for watching, and I'll see you in the next one.